Imagine opening your investment account one morning and seeing something you never expected. Your portfolio is down 20%, then 25%, then 30%. Your first thought isn't about investing. It's, should I get out before this gets worse? And that moment is where successful investors separate themselves from everyone else. Not because they don't feel fear. They do. The difference is that they don't allow fear to make the decision for them. When you're learning how to invest in stocks as a beginner, it's easy to believe that successful investors have some special ability to predict market crashes. They don't. What they understand is something much more important. Markets are emotional machines. When prices rise for months or years, people become confident. When prices collapse, that confidence can disappear almost overnight. This is where loss aversion takes over. Your brain doesn't experience losing money the same way it experiences gaining money. A falling portfolio can feel like an emergency, even when nothing fundamental about the investment has changed. So the beginner checks the portfolio again, then again. They watch the news, they see other investors selling, and suddenly everyone seems to agree that things are going to get worse. That's herd behavior. Successful investors approach the same situation differently. Before the crash happens, they decide what they're willing to lose, what they are investing for, how long they can stay invested, and what conditions would actually justify selling. In other words, they make important decisions while they're calm. That's powerful because you don't want to create your investment strategy in the middle of a financial panic. And here's the part many beginners miss. Successful investors don't necessarily have more courage. They often have fewer decisions to make. They know their time horizon, they understand their risk, they avoid putting money into volatile investments that they may suddenly need, and they understand that a temporary decline in price isn't automatically the same thing as permanent destruction of wealth. This doesn't mean every stock should be held forever. Sometimes a company really does deteriorate, and selling can be the rational decision. The lesson is to distinguish between a broken investment and a frightening market. That's the psychology of investing. A market crash doesn't just test your portfolio, it tests your preparation. So before you ask, what should I buy when the market crashes, ask yourself something more important. If the market falls tomorrow, do I already know how I'll respond? Because the strongest investors aren't necessarily the people who feel the least fear. They're the people who prepared their strategy before fear arrived. When the market gets loud, your plan should become louder.